Hey everybody, hey traders, Chris Pulver here. Happy New Year's Eve. It is December 31st, just around 7 p.m. Eastern Time, and the year is officially in the books. Just wanted to highlight a couple of things, and that would include the S&P ended up closing the year out with a 23% gain. The NASDAQ closed out with a 29% gain. The Dow closed at 13%. The Russell had a nice little stretch and then gave some of it back post-election. We see some, winners and losers and movers and shakers. Not all markets finished green this year. Taking a look at the S&P heat map, we have some big ones out of the Mag 7. Really, we had about 10 stocks carry about 40 to 50% of the S&P's gains this year, which is pretty remarkable. Let's just call out some notables that had some fantastic years. Eli Lilly finished the year 32.44% positive. Google 35.51%, Meta up 65% this year, Netflix over 83% this year. That's massive. Nvidia up 171%, just staggering. AVGO Broadcom, after that last push we had in December, AVGO is up 107% year to date. Microsoft only up 12%, interestingly enough. Oracle, some legacy tech coming out there, 58.06. Adobe down on the year, 25%. Palantir, ridiculous, one of the top, if not the top performing stock of 2024 in the S&P 500, 340% gain on the year for Palantir, the stock that wouldn't quit. Apple up 30%. 30.07, Amazon 44.39, Tesla 62.52, with most of that gain, by the way, coming after the election. We started off on a pretty rough note on Apple and Tesla, and Tesla just had a massive surge after the election. Walmart up 71.93% for the year, and Costco up around 38% for the year. So there's a lot of other ones. There's a lot of green on the board. Advanced decline, we probably saw, I'll just check the numbers here. So if I go advanced decline, for the year, let me see if I have. Let me check real quick. But I want to take a look and see. Okay, that was the year that was. Now, more important is the year that's going to be. Right. So 2024, put it in the books. We've had a heck of a run. You go back for the last couple of years since the October bottoms after that 2022 correction. This low to high. I mean, this market has been just an absolute face ripper to the upside. Power to the bulls, 74% from the bottom. Now, obviously, not everyone caught that, but if you stayed invested in the market, you had plenty of gain potential there. That's an incredible run on an index in just over 2 years, right? So, 2023 was where the broad market got a little bit stronger through a May and November surge. And then 2024 was mostly carried by AI, risk appetite, continuation, breaking new highs, momentum begets momentum, all these things. And we had a little April hiccup with inflation story. We had the SOM rule and the employment scare, the deleveraging from the Bank of Japan in July to August. Market did not care. We got into the election. We surged on the election. We faded and gave a little bit of it back, almost a lot of it back. Now, the Santa rally, we're still not done. We officially would take the Santa rally into January 3rd, which is going to be this coming Friday. But is there enough to really make any dramatic movements one way or the other? Probably not. If this market continues to unwind just a little bit, I think this is totally healthy. I called out a couple levels here. The 575 symmetry is based on this right here. We have a high, low, lower high, lower low. That's my symmetry at 575. If we have a typical head and shoulders right in this area, left shoulder, head to neckline, if we are breaking that neckline, then we would take this measured move. So this measured move right here, and then project that down towards the 560 to 555. So the reason I have about a 5-point move is because of this little PCE low that sticks out from the 2 days and 3 days of support that we saw the last couple of days. So, would I like to see a correction in those areas? Of course I would. Would I like to buy a discount and get a discount on the SPY? Yes. Would I think it's going to stop there? Not necessarily. But if you just take a look at this market that's been, going at a pretty healthy clip for the last 2.5 years, a pullback into a bar count, almost a 300 bar count on the daily exponential moving average, to me, technically makes a lot of sense. And that was a 290 bar count according to today's close. The stretch away, since we did not continue to make all-time highs once we hit about 609, that stretch away move was around just shy of 10%. Now, I've seen it go further in the past, but if you take a look, even where we had this correction back in April, from this April high, we were sitting around 11.5% above the 200 moving average. So we got a little choppy here. There was not a lot of volume to carry the markets higher. The only thing driving us towards these highs at this point was the Mag 7, and it just didn't sustain. The market breadth started to dissipate. The concentration's too noticeable, and there probably was some profit taking, maybe some portfolio rebalancing, some strategic reallocations, things like that, that caused a little bit of a stall at the top. But FOMC was really the catalyst that kind of drove things lower. The market was not too thrilled with the fact that the Fed may be pausing through a lot of 2025, maybe 1 to 2 cuts, and we don't really know when that's going to be. So for the outlook that I see here, my preference would be I'd love to see a bit more of a correction into my symmetry levels. I'd really like to start scooping up some buy opportunities in the the 144 period moving average or the 200 period moving average. I will start looking to deploy some capital that I've had in the sidelines and in some cash positions for a while. That would be just on the broader index. So SPY, SPX, anything in futures. If I'm looking at establishing a bit of a directional play with some options, I really like that zone. So I would just say 560 to 555 is a symmetry move, but a 560 to 550, I would still be willing to kind of. I don't have to be perfect, right? I don't have to have the exact bottom there. I don't have to time it super well. But if price comes down into that window, I'm interested in deploying some capital and getting long once again. Because if we had a correction, let's say down to the 200 moving average, that would be a nice little 10% correction from high to low. Okay. And if, as this is a dynamic indicator, it's going to be about a 9% correction. So if we were able to see like a 7 to 10% correction, I'd be pretty happy with that. Start looking to establish positions. I'd probably go out, maybe 60 to 90 days on some of my option trades. Maybe I just look out for the next 6 to 12 months and see if I can get some leaps going toward the end of the year and just see if the market can kind of create, okay, there's a nice little low. Do we create it in Q1? Maybe. Do we create it, the second half of the year? I don't know. I think the harder part for trading in 2025 would be this. If this market does not finish a corrective move here, if the market does not finish a corrective move and we basically don't take out this PC low and we just have this type of movement, that type of movement right there, I know that it can still break. I know it can still go higher. But I think that a lot of the air and optimism in 2025 has been kind of let out. Since we gave back a little bit of the election gap and the Dow gave back pretty much all of it with one of the worst losing streaks we've seen since 1974. The S&P is not that far behind. Equal weighted markets like the RSP, QQQE offer it's not having the same type of market cap weighting like we have in the SPY. We've had a pretty healthy pullback here, right? This is around an 8% pullback from top to bottom. So we had about a 7.7% correction in the RSP. It is certainly lagging the SPY, but the SPY is a pretty ingenious ETF simply because the biggest and strongest companies can still drag this thing higher. It doesn't need 500 stocks to go higher. It literally needs 7. It needs 10. It needs 3. It needs 1. When we started hit all-time highs this year, early in July, the only thing that was up there, I remember looking at a heat map this year where in July, the only thing that was up was NVIDIA. Like it was pretty much like 499 stocks were red and NVIDIA was green, and this market was still making higher highs in July. So the SPY doesn't need to have every stock performing well. But that being said, that amount of concentration at the top is what makes it a little bit cautious, right? I would say I'm a little bit cautious for that exact reason, which is why I would welcome a bit more of a correction to the downside to offer up some slightly better valuations instead of drifting up towards the PE ratios at these highs that we haven't seen since 2021 or back into 2007 or back into 1999, 2000. It's those same type of stories where, are we climbing the wall of worry to get to a bubble, or are we going to see a reasonable, ventilation where the market's able to find some justification to buy the discount, see a healthy economy, and then figure out where we can start trading. Obviously, the market does whatever it wants, but I would like to see some healthier opportunities. Let the wind out a little bit, where this can just come back to some better valuations, and then offer up opportunities to get some buying back. So that's the preference. What else do we have here? Let's talk volatility. So the VIX, we had, this is wild, by the way. One thing that 2024 will be remembered for is 2 of the largest single day volatility spikes ever. It happened on August 5th, and it happened here on the 18th with the Fed FOMC. Crazy stuff. Again, testament to the time. I mean, volume was pretty light. The markets are being kind of bullied around with some just aggressive order flows in a thin market, and the Fed was a big day, and they They really said things the market didn't like, and so it took it down quite aggressively for the day. We had that little Santa rally that got us pretty much back up to where we started, but it got faded. So we're going to see if that fade continues to happen. Volatility, like we saw back in 2022, was not crazy high with these one-off days, but it was very steady as we were going basically between 20 and 35 through the entire year until we had about a 9 to 10 month correction, finally hit a bottom in October 2022. So is this what I'm expecting in 2025? No. But just looking at the VIX as an instrument, we don't have to have these outlier VIX events. If we just have like a little bit more volatility here, that's a good opportunity to look for, selling premium. Higher volatility, selling premium is good strategy. Looking for bottoms in the market, that would be a good strategy. So I'll keep an eye on this. Otherwise, it's obviously interesting to get long volatility if we come back down to these really suppressed levels like we saw through most of 2024, which is also why we had a bit of a vol event like we did back in 2018. Okay, that was our COVID vol event, which was obviously a big one. And then back in 2018, crazy suppressed volatility, and then just a huge explosion back in January, February of 2018. So nobody knows what's going to happen in 2025. I'm just as excited as everyone else to trade it and figure it out. Let's talk some other charts here. Dollar index 108. This is still a chart that I don't feel like I should be fighting. I'm not going to. I'm not doing anything on the dollar index outside of looking for long positions. I had mentioned to traders these last couple of weeks, don't fight the dollar index. One byproduct of looking at, we saw this narrative a lot in 2024. And that would be that the Fed and the dollar is the cleanest dirty shirt in the laundry or something like that. What that really means is, look, other central banks are cutting rates and cutting rates a little bit more violently, and they almost have more of a dovish tone, where the Fed just kind of paused and even pivoted to a neutral to hawkish tone. So if this still offers some yield, we are in a positive swap environment with these interest rates still being 3-4%, 3-4-5%. So the dollar could still be something that gains against its counterparts, and one trade to watch would be the euro dollar, right? The euro dollar has fallen below this 105, 106, very sticky support zone. And since we have come back down to these lows, I would say that if this euro dollar breaks these fresh lows, this was like a little PMI flash crash we saw a few weeks back. If it breaks these lows at 103.50, there's not a lot stopping the euro dollar until we hit parity. And if you look left on the chart, there's not a lot stopping parity until we maybe get down to like 9,600. So in the near term, I think traders that chose to short the euro dollar, stay long the dollar, this has worked out to be a pretty great trade, obviously, with that nice little double top around 112. But we've moved about 900 pips. And if we go lower, I could see 1,000, this would be a 1,200 pip trade, right? If we go from 1,200 to 1.00, that's 1,200 pips. If we get all the way back down to this low that we saw back in 2022, would that be enough? Would that be a 1,296? That's a 1,600 point move. Is that enough to kind of call some bottoms on the euro dollar? Is that enough to call some tops on the DXY? I think that's a really interesting trade for me in 2025. Is if the euro dollar hits parity, I'm probably going to be on the contrarian side of that trade. This hits parity, I'm probably looking to scale in and then wait for some confirmation to get us back up into 105 again. That, like I said, that might be an unpopular trade, but that's one that I'm certainly looking at doing for 2025. I'll trade that really small and I'll kind of test the levels. Oil continues to be a chop fest. We haven't broken 67. I told traders this last week, if oil is going to get strong, and we start to see this inflation narrative spiking back up, I think oil needs to make a nice clean break above the 200 moving average. And right now it's not doing it. So we may come back up to the 200 and it might fail. And it comes right back down to 67. And this continues to get tighter and tighter and tighter. Now, eventually that's going to have to lead to some type of decision, right? I don't think oil can get tighter and tighter and tighter and do that forever. Sustainably, we're going to have to see some type of move to the downside or some type of squeeze to the upside. Natural gas has been going up. We'll see if energy prices are going to stay suppressed or start to rip a little bit higher. I think one thing the U.S. certainly wants to do in 2025 is drill, not just internationally, but also domestically, and see if they can continue to add more supply and keep oil prices and energy prices as low as possible to keep a little bit of a lid on inflation for right now. Here is CL futures. If we're not breaking above that 200, I'll just keep an eye on this tightness. Natural gas continues to kind of get more and more volatile. We had a nice little head and shoulders pattern, and we broke the neckline around $3, and we are up. I think there's room to get up into this 470 to $470 to $5 zone on a measured move. I'm not long natural gas unless we get a pullback into some of these daily moving averages. So if we get a pullback into here, maybe some defined risk to try to get back to these highs and finish this move back into around 470 to $5. Okay, gold and silver. I'd still like to see a bit more of a correction. If the dollar gets stronger, expect gold and silver to be a little bit on the struggle bus. So high, low, lower high, lower low. I do like gold a lot at the 25 to 2400 zone. I'm going to be patient to see if I can scoop up some more gold exposure at those levels. We go to silver. Silver's hanging in there right around $29. Still very well supported around 26. I'm hoping we're not going too much lower. But even if we do, I'd still like to establish some more core positions here around 26 and see if we can make our way back up eventually to 35 or $36. So I still like silver. I still like gold. I'm going to play those a little bit more longer term. Bitcoin is being somewhat resilient, but called the symmetry level pretty nicely. We had this move right up towards 107 to 108,000, and we kind of topped out from there in the near term. Now I like the 90K to 80K pullback zone. If we pull back to previous all-time highs around 75, some dollar cost averaging would not be a bad thing. I think the securitization of Bitcoin, I think the ease and the ability to trade it in stocks and options now, I think the order flows are pretty amazing. Bitcoin ETFs like IBIT have seen more inflows in that ETF in a year than it took GLD to do in like 8 years. So there's clearly demand for Bitcoin. Is it sustainable? Is it the forever digital coin? Is it the gold standard? I have no idea. Okay. I still think it's risk capital, but it's been a crazy good run, and some really healthy gains this year were because of my Bitcoin exposure. Not just having, a cold storage wallet and just typical, Coinbase wallet or a crypto wallet, but also because of BITO, because of IBIT, because of FBTC, because of GBTC, all those approved ETFs that offered just more order flows, and it was really a kind of a self-fulfilling move. This was a great technical trade where we had a lot of momentum. This was the ETF announcement pullback. It started to rip up here, okay, and then just months and months and months of consolidation, and it just started to make higher highs and higher lows, and then through the election surge higher. But this is a nice little inefficiency from between around 85 to around 70. So anything in that window to me is an opportunity to look to buy. If you want to, try to time your levels a little bit more, then look for confirmation on the right-hand side of some type of pullback trend line or something like that. But I like those levels enough to kind of dollar cost average in for the next like 6 to 12 months. Okay, MicroStrategy. This one's pretty wild and crazy. I do have some shares of MicroStrategy. My current cost basis is around $290 right now. I literally bought it at 346, and within 2 option trades, I now own it at 294, I think. So I'm still riding this. I have a collar trade, which means I have a sell call, which is at 305. And I have a buy put, which is at 245, which is an out of the money. But if this continues to fall aggressively, then my 245 is likely going to be worse in profit. And I will use that to lower my cost basis. I'll continue to sell premium on the call side. And if I can work my cost basis on MicroStrategy down to, let's say, 250 would be great, but let's say 225 to 200 would be ideal. And I will always have some protection to the downside. This could be one of the biggest kind of bubble stocks that we've seen in a while. But it's still, you read the headlines, Michael Saylor and MicroStrategy are still buying Bitcoin. And if Bitcoin stabilizes and heads back up to all-time highs, I'm sure that the performance of Bitcoin going up will be seen with, a magnified move in MicroStrategy, which makes this really interesting. The premiums are incredibly rich, and so I mean, for me to lower my cost basis by $50 in 2 trades is pretty impressive, but I do need to have protection always to the downside, because who the heck knows what's going to happen. Okay, so I'll keep an eye on that one. And I would not be doing this if this was if this was $1,000 stock like it was before the split. There's no way I'd do this. But the fact that we had this run, I did a lot of income trading down here in the $100 zone, and then I did a lot of income trading through the election as Bitcoin. It was kind of another way to play Bitcoin. I took a lot of the profit through the run, as this was kind of front running the Bitcoin move towards 100K and beyond. Now it's given a lot of it back. So I mean, percentage wise, you see this high. This has already experienced a 47% pullback on MicroStrategy, and Bitcoin is a fraction of that. So here's Bitcoin pulling back around 15.5%. MicroStrategy is clearly its own like leveraged Bitcoin strategy or Bitcoin correlation. So be careful on this stuff. But if you know what you're doing with some ownership or some options, there is a lot of good premium in MicroStrategy. Coinbase ended up taking some profit. I had a 230 by 220, actually a 220 by 230 bull call spread. So that one is done. I took profit on that today. The other ones, I've got a 220, 210, and 200. That is a 111 trade, collected $3.33 a contract. I don't plan on owning Coinbase. But even if I did, I wouldn't get assigned until $200. And if I own it, I would own it at 186 and change, because I'd have $10 from a bear put spread plus the assignment price. So that would be $10 minus the 200 assignment and the credit on top of that. So that would be $13.33 discounted for my $200 sell put. So it's a pretty good spot to own it. And again, discount wise, if I owned it around 187, that would put me down to about a 46, 47% discount from current highs. Would I like owning it there? Maybe. It really depends on what Bitcoin is looking like and if it's worth owning. But I will keep an eye on that one. What else do we have here? Argentina could be an interesting trade in 2025. The DAX is pretty well supported with these dynamic moving averages, so keep an eye on that for Germany. If we pull back into the deeper, 50 to 100, even the 144 to 200, the DAX is looking pretty primed for more buy zones until it doesn't. Obviously, if price aggressively comes back down here and takes out some lows, we might be putting in a topping pattern. But if this is just an orderly fall, okay, and we get some opportunities to buy low, then let's see if we can get the DAX to resume this trend. The FTSE has given a lot of chop this year. We're kind of sitting at these range lows. I'd say this is an important spot. If these lows hold, then the FTSE finds a way to get right back to these highs. If this low breaks, I think we've got trouble in paradise, and the UK is looking pretty rough. So that's going to be one to watch those lows, watch those highs. Argentina, I think a pretty good looking story for 2025. One of the best runs of controlling inflation that the world has ever seen. Inflation was running as high as 25 or 30%, and it's now down to 2.4%. So I like Argentina and what they're doing. I think this offers a good plan for anyone else, like the US, for example. Hint, hint. Could they balance inflation a little bit? Could they help ease inflation? Could they actually put the market into, have inflation and technology actually help the economy instead of making things more expensive, where clearly things in the US are more expensive? So does Argentina have a bit of a pullback here? Hopefully it does. It's been a really good run since the August bottom. And I would just look left on the chart, see if I can find some deeper pullback zones, and then look to get long again on Argentina. So ARGT is a way that I trade that. China, interesting story for 2025. Will we see additional animal spirits in the domestic market be supported by China? Will they support the property market? Will they support the capital markets? Will they put in essentially a floor in the stock market? Personally, I hope that they do, because I have some exposure in this. If we have a nice swing from that, that big announcement of stimulus, this is the biggest package they've released since COVID. Is this a bullish pattern right here? And do we make our way back up to this neckline? Do we get back to revisit these highs? This to me is a good looking trade for like Q1 and Q2. We're going to see what China's policy and support for their economy is made of in Q1, Q2, if they're willing to keep talking and adding stimulus. I don't know if they will. That's been the big letdown, was they talked about it, they kind of did it, but the market was a little bit disappointed with, there was kind of a one and done deal. So 2025, we need to watch that. All right. Let's see here. Brazil, have some exposure on this one. I'm down, I think, like $6 a share. We're coming down to the levels we haven't seen since COVID, and even back into the 2015 area. I wouldn't mind looking at some additional exposure into that like $20 to $19 zone. I still see that chart alarm at 2150. I'll look at the COVID lows, excuse me, and then look at some type of synthetic trade. I put that in my chart alarm there, a zebra trade, which would be I buy 2 calls and then sell. I basically buy 2 70 delta calls and I sell a 50 delta call, and it gives me a synthetic a 100 delta. All that is I can trade the instrument a lot cheaper with the option than I could if I just bought the shares. So we'll see. It's like I said, it's like a synthetic long, right? Let's see here. Apple, Mag 7. We gave back a little bit the last week or so. A lot of the market kind of pulling back from that FOMC shakeup, plus fading off that level. Apple's giving back a little bit. Amazon, same thing, giving back a little bit. Google, same thing. I mean, this ripped on quantum computing, a little bit of a pullback is totally fine. Still looking for dynamic support. Meta has a really high bar count. I'd almost love to see Meta. I would love to see Meta come back to the 144 200 moving average before I start establishing more positions. And if it is falling, I'm going to start looking at income trades first before I start looking at dollar cost averaging into Meta. 2022 Meta was down like 76%. So as good of a stock as this is, as much as it was awesome to watch this thing go up 75% this year, it's a stock that could also drop from these all-time highs. It could drop 30, 40, 50%. So I don't want to sit here and call, hey, that's a good spot to be buying, and this is only a discount of about 17 to 18% when it's going to pull back maybe 50 to 60%. Who knows, right? So trade it small, keep the income trades, trade options. That's my plan for Meta. Microsoft has given some back. We didn't quite get to all-time highs. I still think this is a good opportunity to establish some core positions in here. So more income trades, which I have one right here to February where I would own some Microsoft at 375, actually lower than that. But just looking at some income trades there and trying to play this $400 support. Netflix, another high bar count. I'd love to see this one pulling back into the 100, 144, 200 moving average. Nvidia, I actually took on some shares this last week. I tried to do a ratio spread and take on ownership at $125. It didn't work. I didn't get any assignment. I just kept the income. But I decided on a credit spread, a little tiny credit spread, a 138 by 137 credit spread. I now own the shares. I have them with a break even of 134.64. Just depends on the accounts that I'm trading, but roughly within about 20 cents of my break even. So 134.64 to 134.86. We're trading just around that right now. I have a buy put at 130 to protect the shares. I have a 140 to get it called away to make a quick little income trade of $500 to $600. So if it falls lower, and this is kind of what I'm hoping for, I would hope for this to fall a little bit lower towards this 200. I can use my put, protect my profit on that put, take in the ownership, lower my cost basis even more. If I could own this at 120 or 115 or 110, way happier to own it and then try to let the upside really start to go up. So that could be a really nice run for 2025 if I can lower my cost basis and then get this thing to turn around, finding some really nice support. And to me, that support level that I'd like to be buying from is the 120 to 115 area. Tesla, also pretty volatile, 80+% move post-election. I have a couple of dollar cost average levels in here. I also have some income plays. Tesla's probably going to be a pretty good play through 2025. You essentially have Elon Musk, head of the table at Tesla and very close to the president. And, when you're that close to power, good things tend to happen. And whether you call it corrupt or not, like Tesla's probably going to benefit. I'm very curious to see what like the chip space looks like with Tesla in the game, or autonomous vehicles looks like with Tesla in the game. If there's any type of like automation for humanoids, or automation for manufacturing, automation for assembly lines, automation for anything, better energy plays with batteries and gigafactories and expanding energy, blah blah blah. All this infrastructure that companies are dying to invest in. If Tesla is going to be putting itself in that space, so keep an eye on that stock, but. It's an interesting trade. Tesla's crazy volatile. There's a lot going on with Elon Musk. I do think if that the DOGE fails, that Department of Government Efficiency, if that fails in, I guess, amazing fashion, then perhaps Tesla takes a bit of a hit. But there's a lot of run as we came back to retest these highs, and I think that this is just the start of this head and shoulder breakout, clearing new highs, and we'll see where this momentum goes. But a pullback would be fine, and I'm happy to get some pullback and dollar cost average levels in. Berkshire Hathaway. I'm going to keep a close eye on this one. They were a net seller of stocks in 2024 with Q3 especially, cleared out a bunch of Apple, ended up making some buys recently in OXY and a couple other stocks, but OXY primarily. But they cleared up a lot of positions in Bank of America, a lot of positions in Apple. This is kind of like trading the S&P, but not. Their companies had a pretty good run. I would look to see if we hit the 200 moving average or pull back deeper. This is a stock that I wouldn't mind taking some ownership of. And if I did own it, I'd own it around 406 or 407, which is a pretty healthy discount for a stock that's not crazy volatile. Bonds and yields. Big story for 2025. I do not want to see the 10-year yield go higher. The problem is that it might. If the 10-year yield goes higher, I'm really concerned with the ability of the stock market to go higher. I think that a 10-year yield going up means stock market does not go higher. A 10-year yield going down means the stock market can have some legs. So do we have the 10-year going higher to then put pressure on the equities market to fall enough to then top the yield and then bottom the stock market? Maybe. So maybe that could be a good thing if it happens early enough in 2025. Maybe we get an early cleanse in January, right? We just have like a rough start for the year. Trump can come in and blame the Biden administration for 4 years of terrible management, and I'm going to fix everything. And what happens? Well, we see a crazy crash and reset where the bond yields go up to levels that are just very, very threatening, and the equities market takes it, and that 23% year to date is chewed into quite a bit. And then we see if we can pick up the pieces at a discount. So I'm watching the 10-year very closely. Okay, we're disinverted on the 10 and the 2 year, and we're disinverted on the 10 and the 3 month. This historically has equaled recessions, and it's not the inversion, but it's the disinversion. And I believe that we are on borrowed time for a reality check to this market. Not just the market, not just Wall Street, but Main Street, which is probably already feeling a recession or some type of rolling recession in different sectors and different areas. But it's being felt. I mean, we've got a lot of Americans living paycheck to paycheck. Inflation is higher. It's stickier. Everybody feels it. Everybody knows it. Some of the crazy stats I pulled this week is like McDonald's for the last 10 years. Prices are up like 60 to 200%. Like just a typical sandwich, a typical drink, a typical fry. It's up, 60 to 80%, 100%, 200%. So that's McDonald's. That's supposed to be cheap food, right? You get a value meal at McDonald's. It's the same as going out to eat for like a $15 entree. It's crazy. So not getting better. And if this continues to put the pressure on inflation, then I think that puts a lot of pressure on the equities market, at least in the near term. Mortgage rates, we're sitting at 6.85 on the 30-year mortgage. That's not great for anybody wanting to move. That could be another potential catalyst for 2025 is the unaffordable housing market. And if people aren't moving and the houses aren't moving, what is the government going to do? Are they going to buy more mortgages at 7%? Probably not. Are they going to try to see the market, crash in some way, have a housing crisis or an affordability crisis, and all of a sudden we see the Fed come to the rescue with some stupid plan? I don't know, maybe, but housing market could be a big factor in 2025. A lot of futures feeds there, some other stocks, and that's about it. So anyway, I think there's some amazing opportunities coming in 2025. I hope the market comes with a little bit of a pullback and a cleanse first. If it does, great. I'll be a happier bull. If it doesn't, we'll figure out how to climb the wall of worry. We'll figure out how to navigate it. I'm going to play a lot of necessary defense just because that's what I tend to do. But if there's upside, there's upside. If there's income, there's income. But I'll do my best to figure it out. So that being said, thanks a lot for watching, and hope everyone had a great 2024 and enjoy the New Year's. The markets are closed tomorrow, and we'll be back later this week. So Thursday, Friday trading. Markets should be returning with more volume and more steady flows starting January 6th. And it is a clean slate. So goods, bads, whatever happened in 2024, who cares? Let's do it again in 2025. All right. See you, everybody. Thanks. Bye.